Hey buddy, how you doing? Hope all is well. This is that illustration I told you about today for just a way to diversify your portfolio a little bit. It's what we use to some extent, and I'm just going to send you this video plus some literature. See if you have any questions or anything. So this is based on what you told me that you contribute to your retirement fund currently $400 a month. You could do more or less at any time. Just know that. Page 2 here is just some highlights. It's pretty easy to read, so I'm going to skip over that. So the first thing that I want to talk about here, I said on my text that I just saw my mutual funds and how bad they were doing, and I just thought of you on this. So this type of policy is called an indexed universal life policy. I've actually mentioned one to you before, but now I kind of know what I'm talking about on them. So I'm gonna just present this to you. So anyways, the index part of it is where you get that safety and you can't go below zero. There's a couple indices on this page that I really like. This is the one I use, this S&P 500 point-to-point cap focus. So basically what the 9.75% means is that is your ceiling. You're not going to make above 9.75% no matter how it does. But also you're not going to go below zero. So a good example of where that really helps you is in a year like 2008. S&P's down 38.5%, you make zero. There are some other indices that actually had positive crediting in that year. So this is another really popular one over here, this Credit Suisse. I tend to look at their their long-term averages, so like their 15 and 20-year averages. So like the one I use is over the last 15 years, 6.18%, 20 years, 5.54%. And then that Credit Suisse is really nice. I might think about doing like a 50-50 split between those two if you went with this. But 10-year average is 8.15%. 15 is 6.95. But again, I think the biggest thing on here is, think about a ratchet effect. It's kind of like when the government implements something, it's not going back. Well, this is kind of like that for your money. Once it's in there, it's not going back. The worst you're going to do is stay flat and then hope for those positive years in the future. So this is kind of a safe money option. So this is where kind of all the real information is. So I'm just going to kind of go over this. So first of all, I had you doing $400 a month for most of the life of the policy. Once the kids were kind of starting to get out of college, I had that raised to this would be $500 a month. And then I think I had you putting in $600 a month the last few years. So just know that you don't have to do that. Obviously, you can do less or more. Actually, there's a minimum payment with this that's it's about $175 if you ever got in a pinch. So that's nice. So anyways, these are your premiums over here where it says premium outlay. This is your interest crediting, and this is based on a historical average here, just so you know where they get the numbers. This is your savings over here that accumulates. So you see it takes a little while to get going, but after 10 years, you got a nice savings of 41,000 and change. A nice advantage to this over like a 403b is that at any point you can take out any amount, obviously below what you have, penalty and tax free. That's another big thing about all this is the only product you can get that's going to provide you with a tax-free income stream. So it's post-tax money, but even like with a Roth IRA, you have to pay tax on the growth. This you don't. So anyways, this is the savings. So what I meant by that freedom is, let's say in year 15, you got 81,000 stacked up. You and Brittany want to make some renovations to the house. Uh, and you don't want to go into debt for it. So you say, write me a $15,000 check. They will. Like I said, that'd be tax and penalty free, even though you're only 48 years old at that time, and you don't have to pay it back. If you don't pay it back, it just comes off of your death benefit, which I'm going to talk about here in a minute. But anyways, it starts to accumulate pretty nicely as you go. So we'll get back to that later. Another reason why this is clearly not like a 403b is that it's tied to a life insurance policy. So one good thing is you wouldn't have to take another paramedical exam. These are non-medical, and with your history, you'd probably get a preferred rate. So I illustrated this with a preferred rate, just so you know. I would bet you would get even the level better. Not that that's super important, but so this is the amount of death benefit you have right off the bat. So if I were you and you did this, I would just cancel your $22 a month policy you got with me, because that's close to 500,000, and it continues to grow through the life of the policy. So you don't have that full 500,000 in coverage, but you got close. And it's 500,000 12 years after year 12, and it just continues to go up. And so just like your term policy that I gave you, this has living benefits, kind of a lot more though. So if you have any of those supplemental policies from school, like I think you have a cancer policy, long short-term disability, anything like that, I would get rid of those if you got something like this, because again, throw out a scenario. Let's say you're 48 years old in year 15, you get hurt bad, doing something, you got a critical injury, you miss 6 months of work, you can access up to 93% of that, whatever your death benefit is. In this case, it'd be 525,000. Not that you would need that much, and you wouldn't want to take that much if you didn't need to, because that would lapse the policy, but you have all that protection right there. So just to show you a little bit of how you could use that. So one way you could use it, and this is a long time down the road, but is for a chronic illness. So this is like where it would be your long-term care facility. I know you probably haven't priced out long-term care policies, but those are like $600, $700, $800 a month, and if you don't have it, a long-term care facility is like, $700, $800, $900 a month, $1,000 a month. Whereas this will kind of take care of that for you if need be. Also, all of these types of illnesses and injuries are covered. And what I mean by covered is you can access that death benefit. So any of these over here, ALS, cancer is a big one. That's why I said you get rid of your cancer policy, because this pays you cash just like that does. Heart attack, another big one. Stroke. I think diabetes is on there, but they don't have it listed. Any of those types of injuries as well. That's all I wanted to show you on that. Yeah. So anyways, yeah, this is just a lot more than just a death benefit, and it is a death benefit too. That's legacy protection right there that you can leave behind to the kiddos, that keeps growing. So I want to kind of fast forward to your retirement age. We always just run them out to age 67, but that can be changed as well. So remember, for the life of the policy, you paid $400 a month, most of it, up to $500, and then finally up to $600. But that's going to change depending on what you put in there. You can put more or less. You can also do like tax returns in there and stuff. But anyways, at the end though, once you set your retirement age, you've kind of bought the house at that point. You pay no more at whatever your retirement age is. Like I said, you bought the house, and this is where the retirement plan of it kicks in. So with this illustration, if you paid the premiums I said, then you'd be making about $40,000 a year, which would obviously be in addition to your pension. The difference between this and your pension is, like I said, this is the one product on the market that is tax-free. That's totally tax-free income. That's not taxable income. It's given out in the form of a loan, which sounds like you have to pay it back, but you don't. It comes off of your death benefit. So technically you pay it off when you die, but it's nothing that you have to pay back. If you didn't need to take the loans, if you didn't need that supplemental income, then you leave it alone, and you're just really stacking it up on your net death benefit. So that is based on the fact that over the life of the policy, you accrued $436,758 in savings. Like I said, that accumulates to $40,000 for the rest of your life, tax-free. Rest of your life means age 120, so you're not going to outlive it. And as you can see at that point, your savings starts to decrease. So does the death benefit. So the death benefit, the highest that goes, assuming you take the income, is $850,000. And so that just decreases as you take those years and years of income. And this does a nice job of also showing the breakdown. So when you're 73, you paid in a total of this much in premiums, about $200,000. You've already received an income more than that, just after 1, 2, 3, 4, 5, 6 years of income. You're above what you put in, and you still have $340,000 in savings and $573,000 in death benefit. And it tallies it as you go. So when you're 83, you've received that much in income. Your savings is down to $181,000. Your death benefit's down to $238,000. So, anyways, that's just kind of how it works. I think I've hit pretty much the high points. So I'm going to send you this and basically an article that kind of talks a little bit about it. If you are serious about moving ahead on this, then you'll probably have some questions for me, which will be just fine. I wanted to pull up Courtney's policy so I could show you the way we're using it for her. Basically, we're funding it. We're funding it pretty good right now, just so we'll have money accrued for college. We're going to take out about $10,000 a year in her college years, which won't be everything, but it'll be nice. And then when it gets to the end of the road, when it gets to her retirement years, it projects to pay her about $80,000 a year. So it can be nice for the kiddos too, for a lot less than we need to pay to accrue that money. So I'm going to stop it here. I don't want to get too long on you, but you know how to get a hold of me if you have any questions, and show it to Brittany, see if she has any questions, and we miss you guys. Brittany said, or Maria says hi. Courtney says hi. Hi. All right, that's for the kiddos. See you guys later.